You're listening to the Financial Source podcast on YouTube.
Hi, everyone, and welcome to the Financial Source podcast. We are entering what feels like a really pivotal phase in global finance. It's being defined by this deep central bank caution and, well, a serious sense of policy division.
And that division, it was just laid bare in the latest minutes from the Federal Open Market Committee. It shows that policymakers are truly wrestling with late cycle risks and, the uneven progress on disinflation.
Right.
So as these global banks try to navigate a real data fog, especially with delayed employment numbers in the United States, you're seeing markets pare back their expectations for any immediate policy easing.
So this deep dive is all about pinpointing exactly where that policy direction will be set this week. We're looking at everything from the highly anticipated move by the Reserve Bank of New Zealand to that critical fiscal credibility test that is the United Kingdom autumn budget.
Yeah, we'll examine the specific catalysts shaping expectations into the year end. We're going to connect the dots from, say, Australian inflation figures all the way to updated long-term projections from the European Central Bank.
Here's what you need to know.
So let's start with the Federal Reserve, because their recent minutes, they revealed a level of internal debate that is, I think, far more significant than just a simple disagreement on the margins.
Oh, for sure.
It really highlights this profound uncertainty that's facing modern monetary policy.
I found the numbers genuinely surprising.
Yeah.
We saw this massive divergence in views on what the right pace of easing even is. You had many participants who favored a traditional 25 basis point cut.
Standard move.
A standard move. Then you had several who preferred holding steady entirely.
Yeah.
And then there was one participant who was advocating for a really forceful 50 basis point reduction.
And that's not just a technical debate.
No.
That is three completely different readings of the current economic playbook.
Exactly. So if we break down that rationale, what is the split really telling us?
It's all about their models, right? The participants who supported that forceful cut are signaling this deep concern that they are already too restrictive. They're emphasizing rising downside risks in employment, and they're noting, pretty limited evidence of renewed inflationary pressures.
So they see a hard landing as the bigger risk.
They see the possibility of an unnecessary economic hard landing.
Yeah. But then you have the pro-hold camp. They're stressing this stalled progress toward the 2% target, and they're basically saying, we just don't have enough confidence in a sustainable disinflation path.
Right. Their fear is that if they ease too early, inflation expectations could become de-anchored,
which would force them to tighten even more painfully down the road. Yeah, it just speaks to this fundamental uncertainty about how restrictive their current policy truly is.
And what's particularly fascinating to me is this added layer of vigilance. It ties right into that late cycle risk environment. The policymakers were explicit about financial vulnerability.
Lateral work.
They noted the specific risk posed by elevated asset valuations, specifically calling out artificial intelligence-related equities.
Let's just pause on that for a second, because that feels like a significant moment for the Federal Reserve.
Yeah.
They are essentially commenting on a speculative bubble.
They are. They warned that if investor expectations shift abruptly, you could see a disorderly market correction.
So is this a structural shift? Is this them layering financial stability risks right on top of the inflation fight?
Well, it suggests they are trying to preemptively manage the tail risks, the risks associated with that kind of speculative exuberance. They remember the fallout from previous cycles.
The dot-com bubble, the housing crisis.
Exactly, where asset corrections amplified economic slowdowns. So by flagging AI stocks, they're sending a message that preventing a disorderly market event is a critical component of their caution right now.
Even if that means keeping rates higher for longer than inflation alone might dictate.
Precisely.
And their whole decision path is now just complicated by a pure lack of timely information. We know the key October and November employment reports, they've been delayed until December 16th.
Which is 6 days after the December 10th policy meeting.
Right.
That delay just reinforces the sense that they are truly navigating in a thick data fog. They have to make their next critical decision without the most timely labor market indicators.
And this is why money markets have already pared back those policy expectations, right? They're pricing in only very minor easing for December. The Federal Reserve is just stuck.
Stuck between conflicting internal views and delayed external evidence.
Okay, so let's pivot. Let's move away from the Federal Reserve. The Asia-Pacific region also provided, I think, a masterclass in data-dependent caution last week. Let's start with the Reserve Bank of Australia.
Yeah, the Reserve Bank of Australia's November meeting minutes, they showed the board acknowledging that inflation had, in fact, fallen sharply since the 2022 peaks.
But there's always a but.
There's a but. They stress a critical detail. Both headline and underlying readings remain significantly higher than their August forecasts. So the progress is real, but it's just not enough.
So they're basically constrained by this data persistence. They judged their current policy stance as only lightly restrictive, and they opted to hold the cash rate at 3.60%.
And the key takeaway for us, for you, is that this is not a sign of complacency. It is a policy of patience. They're just waiting for more evidence.
Particularly on what? Stubborn services inflation.
Stubborn services inflation, wage growth, they need to clarify the persistence of those price pressures before they even think about a pivot.
And this patience, it's expected to last a while longer. I was reading that the tone of the minutes was actually a bit more hawkish than the statement that came with it.
It was. It implies they are ready to act if inflation resurges. You've got institutions like Westpac now projecting we might not see meaningful cuts until late 2026.
Late 2026.
Exactly, because they believe the Reserve Bank of Australia will need to see inflation firmly, and I mean firmly, established within their target band.
Okay, so if we shift focus a bit north to China, the People's Bank of China also maintained this stance of, well, calculated stability. They held both the 1-year and 5-year loan prime rates steady.
For the 6th consecutive month. But China's context is so different from Australia or the U.S. They're dealing with very mixed growth signals.
Weaker exports, soft retail sales.
Tepid loan growth in October. And yet they are prioritizing long-term structural balance over any kind of aggressive immediate stimulus.
Wow.
What we need to analyze is the specific linguistic shift in their policy framework.
You mentioned they reintroduced the cross-cyclical adjustment framework. Now, for those of us who don't spend our time reading People's Bank of China quarterly reports, what does that technical term actually signal?
It's actually highly revealing. Historically, China has used pro-cyclical policy, which means they hit the stimulus button hard in downturns. The cross-cyclical adjustment framework signals a strategic shift. They're now smoothing policy over a much longer horizon. It means they're willing to tolerate slower credit growth in the short term to avoid creating systemic debt risks.
Or feeding more speculative asset bubbles, especially in the property sector.
Especially in property.
So it's a commitment to high-quality, slower growth, even if that means weaker headline numbers for now. A less overtly dovish stance.
Exactly. And this shift has led major investment banks to push out their expectations for the next policy rate cuts to later in early 2026, not now. They are consciously absorbing the current weakness in favor of stability. And that is a significant strategic move.
Okay, so with the global central banks setting this theme of caution, let's look ahead. What are the immediate policy catalysts hitting the markets this week? Let's start with the Reserve Bank of New Zealand.
The Reserve Bank of New Zealand is expected to be the central bank most likely to actually adjust policy this week. The consensus is for a 25 basis point cut to their official cash rate, taking it down to 2.25%.
And that would come with a downward revision to their projected policy path for the next year.
That's the expectation.
So this cut, if it happens, it suggests a different trajectory than their Australian counterparts. But even here, we're seeing internal division. Analysts are expecting a really sharp debate inside the Monetary Policy Committee.
Oh, yeah, with a vocal faction arguing for a more aggressive 50 basis point reduction.
What's driving that pressure for a bigger cut?
The domestic data. It's weakening faster than expected, and inflation is moderating more quickly than they previously forecast. So the proponents of a deeper cut, they see a risk of the economy sinking into an unnecessary recession if they only move incrementally.
But the 25 basis point camp wants to preserve credibility, manage the currency impact, make sure they don't have to abruptly reverse course later.
It's a very high-stakes decision for a smaller, trade-dependent economy. It really is.
Now, shifting to the fiscal side. The United Kingdom autumn budget is arguably the most significant market catalyst this week. And this is not just an announcement. It is a massive fiscal credibility test for Chancellor Reeves.
It truly is. The Chancellor has to present a package that is fiscally credible, singular in design, while somehow preserving the government's growth narrative. The challenge is immense.
They've got an estimated fiscal gap that needs closing, right? Something like between 20 and 35 billion pounds.
A huge number. And if he fails that credibility test, I mean, if the markets perceive the numbers as fudged or unrealistic, what are the tangible consequences?
An immediate spike in gilt yields.
Exactly. The cost of borrowing for the government instantly rises, and you get downward pressure on the pound. He needs to convince the market he can close that gap without crushing economic momentum.
So he has to find these very specific targeted measures, things like VAT adjustments or targeted spending freezes maybe.
All while being scrutinized by the updated forecast from the Independent Office for Budget Responsibility. Credibility here is everything.
We also get insights from the European Central Bank this week with the release of their October meeting minutes. We already know the policymakers unanimously maintained the deposit rate at 2%.
And President Christine Lagarde was very careful to say it was a good place, but not a fixed one, maintaining that data-dependent approach. Markets will be scouring those minutes for any early signals ahead of their critical December forecast round.
And December is critical because it will include the first official long-term projections extending all the way out to 2028.
Yes, and why do those 2028 projections matter so much right now?
Well, they forced the European Central Bank to really bake in their assumptions about structural shifts, right?
They do. To forecast 5 years out, they have to make concrete assumptions about productivity growth, how the green transition impacts industrial output, the long-term effects of demographic changes. I mean, it's a huge undertaking.
And if those projections suggest inflation remains structurally sticky, even with slower growth,
it provides critical context for their entire policy direction for the next few years. It's an exercise in long-term strategic positioning.
Okay, let's turn to the hard data points that these central banks will be digesting. Let's start back in the United States, where we finally get the delayed September retail sales figures.
The consensus is expecting the headline retail sales figure to rise about 0.4% month over month. And this is significant because it really speaks to the resilience of the American consumer.
It kind of counters some of that employment downside risk that the Federal Reserve's pro-cut camp was citing.
It does, and this consumption strength is also corroborated by some real-time data. The Bank of America Consumer Checkpoint showed total credit and debit card spending per household increased 2% year over year in September.
So if consumption holds up, the Federal Reserve has less urgent pressure to ease quickly.
That's the bottom line. Now, moving back to the Asia-Pacific, Australia's October Consumer Price Index data is absolutely critical this week.
Right, given the Reserve Bank of Australia's recent emphasis on inflation persistence.
If those numbers come in hotter than expected, it severely limits their stated ability to afford to be patient. It could potentially force them to reverse their pause, or at least adopt a much more hawkish tone.
We're also watching Japanese inflation closely. It's been stickier than anticipated. Tokyo's Consumer Price Index for October was 2.8% year over year. That was above expectations.
It was. And while analysts expect core inflation to hover near 2.5% into year-end, this is delaying the Bank of Japan's exit strategy from its ultra-loose policy. The key factor there is the anticipation that core inflation will finally moderate next year as government energy subsidies fully take effect.
And meanwhile, up in Canada, we're reviewing their third quarter gross domestic product report. Statistics Canada has estimated that real gross domestic product rose only a very, very muted 0.1% for the quarter.
That minuscule growth just reflects how sensitive the Canadian economy is to higher rates, primarily through its highly leveraged housing market and all the consumption tied to consumer debt.
The Bank of Canada has been pretty clear, right? They'd need a big upside surprise to even consider resuming tightening.
A significant, unexpected upside surprise. Their own monetary policy report projects very subdued growth, averaging only 0.75% through late 2025. They're positioned for a long, slow grind.
And rounding out the data calendar, we have a mix of influential prints, German IFO and HICP data,
which provide context for the European Central Bank. Chinese industrial profit data, which reinforces that slower growth narrative. And then, toward the end of the week, the U.S. Chicago Purchasing Managers Index and University of Michigan sentiment figures.
So every single piece of data is like this tiny piece of evidence that central banks are meticulously gathering.
And it all justifies their extreme caution. The global macro environment is just defined by this caution, by uneven progress toward inflation targets, and a growing sensitivity to late-cycle risks.
The kind that lurk in speculative equity markets.
Precisely.
And that leaves us with the central conflict of the week. You've got central banks worldwide struggling to maintain credibility on the inflation fight while safeguarding growth that appears increasingly fragile.
And that leads us to the final question for you, the listener. Given the Federal Reserve's internal division and their explicit warning about elevated asset valuations, how much of central bank caution right now is genuinely about consumer inflation? And how much is about preventing a disorderly correction in financial markets? It's clear that policy setters worldwide are operating with extreme caution, navigating a delicate balance between price stability and financial stability.
Thanks for joining us for this deep dive into the week ahead. We appreciate you tuning in. Join us again soon on the Financial Source Podcast.